Welcome to another tutorial video. This time around, we're going to address a very common question that comes up whenever you're analyzing companies' financial statements or valuing them, which is what to do with non-recurring charges. And I'll show you the question that prompted this particular lesson. It's one that came in the other day. One of our students asked us the following question. When you're forecasting the income statement, shouldn't you remove the non-cash items such as stock-based compensation and provisions for losses? What about extraordinary items? It's difficult to understand a company if you leave them in there. And then he followed up with this second question. How do you decide when to add back or remove these items and when to ignore them? So these are all very good questions. And in this tutorial, I'm going to walk you through how you would adjust for these items with an example from Alcoa, an aluminum manufacturing and production company. And then we're going to go over some more general principles on this topic as well. So there's a ton of confusion about non-recurring charges on a couple different levels. First off, there's a distinction between non-cash charges and non-recurring charges. And it's one that a lot of people don't really understand because when you are making these adjustments, you don't necessarily want to add back or adjust for non-cash items. You're really more concerned with the non-recurring items. Second, there is some confusion about how to find these items and how much detail to put into it, how much time and effort you should spend on this. Third, there is confusion about what to do with them. Do you add them back? Do you remove them? Do you subtract them? Do you do something else? Do you ignore them? And it depends a little bit on what you're calculating. So we're going to look at that as well. And then finally, more fundamentally, why do these even matter in the first place? Why does the fact that a company has one expense type or one charge that appears once and never again, why does that impact anything in the financial model or valuation that you build for the company? I have to tell you upfront that I have a bit of a personal vendetta against non-recurring charges. And the reason is that they are a very good way to waste time when you're valuing companies. A lot of senior bankers like to punish you by making you go through detailed filings and notes for companies and sift through pages and pages and pages of notes looking for these small charges. And the really annoying thing is that in most cases, they don't even matter all that much. They mostly just impact the historical financial statements from a company. But if you think about it, in a valuation, you're mostly concerned with the future estimates for DCF analysis. And then even with public company comparables and precedent transactions, you're mostly concerned with the forward multiples. If you look at any company's valuation, most of the multiples that you're looking at are going to be for the forward periods. Now, of course, there will be some for the historical periods, especially with precedent transactions. You will have some historical numbers to look at there. And even for the comparables, you're going to have it for the historical numbers. But most of the focus, probably at least 50% to 2/3 or 70 or 75% of the focus is going to be on the forward numbers. So when all is said and done, since you don't project these items, since you ignore them in forward periods in your model, they're not going to make a tremendous impact in most cases. Now, to outline what we're going to go through here, I'm going to start with why non-recurring charges matter. As I said, it's mostly about historical financial statement analysis and the metrics there. Then I'm going to tell you about how to find non-recurring charges and show you a few examples for Alcoa. We'll learn two methods for doing this. One is the quick and dirty method, looking at the company's income statement and cash flow statement. And then you have what I call the hardcore method, which consists of reading through hundreds of pages of really, really boring notes, wanting to jump off the top of a building several times, and then hopefully finding what you're looking for in the end. And then finally, I'm going to give you some rules for when you add them back or when you adjust for these charges in some way. Let's start with part one. Why do these charges matter? The main reason they matter is because they could throw off your analysis of a company, and especially multiples like enterprise value to EBITDA or enterprise value to EBIT for the historical period. Because if a company has a big write-down or a big gain or loss when it sells an asset, that could easily affect the company's operating income or pre-tax income and net income. And so if you're looking at metrics like operating income or net income, you're going to get a very misleading view of how the company is performing because it doesn't represent their ongoing recurring business activities. Let's take a look at this example for Alcoa, the company I've been referring to. I have their income statement up on the screen here, and you can see that in one of these years, they have a really big charge for the impairment of goodwill of around $1.7 billion in 2013. Now, if you go in and enter these metrics in Excel and look at what's happening here, you can see the problem. Directly as a result of that goodwill impairment right here, their operating income falls precipitously in year 2. Their pre-tax income is also much lower. It's negative as a result of this. And then their net income at the bottom ends up being negative as a result of this as well. And if you look at their key metrics and ratios here, you'll get a very misleading idea of the company's performance because their gross margin is increasing, but their operating margin decreases, becomes negative, and then it becomes positive. So it's a little bit odd here. If the company's gross margin is going up and the rest of their expenses are staying in about the same range percentage-wise, you have to ask what is going on here. And on that note, why is their pre-tax income falling and then rising again? And why is their net margin doing the same thing? And the answer, of course, all goes back to this one charge that is throwing everything else off. So that's why we care about it, because it's going to distort metrics like these. And if we calculate EBIT and EBITDA without accounting for this, it's also going to distort EBIT and EBITDA. Of course, you have to ask yourself another question, which is, does this really matter for valuation and financial modeling purposes? And in this case, if you think about it, if we were to actually use Alcoa and use its historical financials as part of an analysis where we look at comparable companies or comparable transactions, we wouldn't even look at year 2 in most cases. We'd really be focused on year 3, the most recent year, simply because you tend to focus on the last 12 months of numbers or the last fiscal year of numbers when analyzing and valuing companies. So if you really sit back and think about it, the answer is probably no, just because you're not going to focus on something from a year or two ago in an analysis like this. So in this case, it's not so much that it's going to throw off a valuation multiple. The issue is that it's going to throw off a lot of the historical analysis of the company. In general, with these charges, yes, they make an impact. Yes, you care about them, but you tend to care about them more when they're very recent, within the past year, or if the company has something coming up that it anticipates that is going to be non-recurring in, say, the next year or the next 2 years or something like that. So that's it for part 1. Let's move into part 2 now and talk about how you find these non-recurring charges. I'm going to go over the easy method first, and then we're going to go into the hardcore, excruciatingly painful method, and you'll get to compare and contrast and see how the first method is a lot easier and saves you a lot of time in most cases. With this method, you have to look at the company's income statement and cash flow statement and search for anything that seems like it might be non-recurring. What that really means is something that doesn't actually appear in every year. So if you go to Alcoa's statements, let's start in their income statement. Cost of goods sold, SG&A, R&D, depreciation and amortization, these types of items are recurring. They appear every single year. They've appeared every single year going back. You're never going to add back any of these. When you go down, you have a couple of candidates that you might add back. There is the impairment of goodwill, and there is the restructuring charge. We'd probably say that only the goodwill should really be added back. The reason why I'm saying that is because the goodwill impairment only appears in 1 year. The restructuring charge appears in 3 years out of 3 years shown on this financial statement. And then if you go back even further, if you go back and look at the company's statements from the 3 years before this, restructuring still appears there. So the restructuring charge has appeared for 6 straight years on the company's financial statements. I don't care what they say about always adding back these charges because restructuring is non-recurring. In this case, it's clearly a recurring charge and we should not be adding it back. Or if we do add it back, we should at least add back a much smaller portion and not the whole thing. Now, if you go down and keep looking at this, let's go to their cash flow statement and see if anything else is listed there. So once again, we have the DD&A, we have the deferred income taxes. We're not going to add back either of these. They're all recurring items. Equity income is also a recurring item, and it doesn't even affect operating income. We will add back the impairment of goodwill. We're not going to add back restructuring. And then stock-based compensation, tax benefits from it, these are both recurring items, so we're not going to add them back when calculating EBITDA or EBIT. Now, this one item, net gain from investing activities right here, this one we might add back, but we need to see whether or not it's really recurring or non-recurring, and also need to see whether or not it is actually impacting the company's operating income. And we don't have answers to those questions yet. Now, as you go down, all these items for working capital, you're never really going to add back or adjust for. And similarly, everything in financing activities and investing activities, you're never going to adjust for anything here because these items have not already appeared on the income statement, whereas items listed within cash flow from operations often have and often represent adjustments to the company's net income on its income statement. So if we go into Excel at this point, if we were to calculate EBIT and EBITDA, for example, we would start with the company's operating income up here. For the impairment charges, we think it's justified to add back goodwill in this case. It's only appeared in 1 year out of 6 historically, so we would say that is a pretty good qualification to be a non-recurring charge. Gains or losses on asset sales, we're going to leave blank for now. Restructuring, we don't believe should be added back because it appears in 6 out of 6 historical years. And then other one-time charges, we're going to leave that blank for now. So let's copy all of these across. Losses or gains on asset sales, we're also going to leave blank for now because we need to look into that in more detail first. And let's add this up and get to our EBIT and EBITDA. So we have that. And we can see already how calculating these metrics and adjusting for the impairment charge fixes many of our issues, because if we go up and calculate the EBIT margin or the EBITDA margin now, as I'm doing, these both follow much more of a clear trend line than the operating margin that we looked at before. This one dipped down because we took it directly from the company statements, whereas EBIT and EBITDA drop a little bit, but overall they follow more of an upward trend over time. So the company's performance makes a lot more sense when you look at these. Of course, we're not quite done with this. We need to do some more detective work on some of these other items. One other thing I'll point out here is that when we're adding back these items, it doesn't matter whether an item is cash or non-cash. All that matters is whether it impacts the metric that you're calculating, such as EBIT or EBITDA. So if you go back to the company statements, yes, stock-based compensation is a non-cash expense. And yes, it impacts EBIT and EBITDA, but it is a recurring item, so we don't add it back. On the other hand, something like deferred income taxes is actually a cash adjustment because you're adjusting for how much in cash taxes was actually paid, but it is a recurring item. And most importantly, it doesn't actually impact the company's operating income at all. All that it really impacts is the provision for income taxes and net income down here. So we're not going to worry about it in this case. So companies will often, though not always, list these types of non-recurring items, the major ones, on their financial statements. And I have a brief recap of what we're doing here. So we're not adding back restructuring. We are not adding back stock-based comp or various other non-cash charges because they're not non-recurring. Gains and losses we still need to check into. And we need to see if there's anything else here that we might potentially add back. So we're going to take a look at the hardcore method now and look through the notes to the financial statements. I only recommend this method if you really have to do it and if you have hours to spend on this task, because it really will take hours sometimes to read through everything there. So be very careful about when and how you actually apply this. So we're not going to read through everything here because I don't want to turn this into a 5-hour long video, but to give you an idea, if you go to the notes to their statements and look at cost of goods sold, for example, they do have a few items here. They mentioned that there's some business contingency costs, a one-time signing bonus for employees. And then if you go down here, they're talking about a fire at one of their locations. And then they talk about a planned maintenance outage at a power plant in Australia. So there are a couple things here, but if you keep going down and looking at this, they have a few items here, such as the write-down of supplies and raw materials. Now that may seem like a non-recurring charge to you, but first off, it's extremely small. And second off, if you actually go in and look at some of their historical statements, you'll see that they pretty much always have write-downs of supplies and raw materials. So in our opinion, it doesn't really qualify. Similarly, these asset retirement obligations and environmental remediation costs, these are pretty much happening every year for the company if you look at the notes in their older statements. So we don't really think it's justified to add these back. Another place I want to highlight here is if you go to page 133 of their 10K in the PDF I created, if you go to other expenses here, this is where we finally get that breakdown of where the net gains from asset sales are. Remember, those appeared in the cash flow statement, and it wasn't clear whether we should add them back because we didn't know where they appeared on the income statement. Well, now we have an answer to this question, which is that these items appear within other expenses or income down here. In other words, they're below the operating income line. And so even if these were non-recurring items, we wouldn't be adding them back because they don't impact operating income. They're not going to impact EBIT or EBITDA, so we simply don't care about these. So I just have a quick summary of that in PowerPoint. And then one final area I'll draw your attention to is on page 107. This is where they give a breakout of the restructuring and other charges. And I mentioned earlier that restructuring itself, the entire expense, should probably not be added back here, but you might make an argument for adding back smaller portions. Now, we don't think it's justified to add back the asset impairment charge because that appears every year. Layoff costs appear every year. Legal matters appear in 2 out of 3 years, and then the others all appear in 3 years there. But the net loss on the divestiture of business here could arguably be a non-recurring charge. Now, to be certain of this, we'd have to go back and check. But just to show you how this might work, we might say in this case, we're not going to add back the entire restructuring charge, but we will add back the 332 that this loss represents. So if you go down here, we might say that we're going to add back 332 in the most recent year and then 0 in the other years. And so now we get to somewhat different results for EBIT and EBITDA once again. So that's just an example of what you might do if you have the time to sift through the filings as I did here. In many cases, you simply won't have this time. And if you think about it, it doesn't really make that much of a difference. A charge of 332, it's good to add it back if it's justified and you have the time to do so, but it's not really going to change the picture here next to that goodwill impairment charge that we added back in the year before. So that takes us to the end of part 2. Let's look at part 3 now and just go through a summary of the rules for when to add back non-recurring charges. When you're looking at a company's historical financial statements, you're not going to directly adjust for them on the statements. Instead, what you typically do is you calculate these other metrics like EBIT and EBITDA that include add backs for these types of items. And in forward periods in the future, you're not even going to project something like goodwill impairment or other write-downs or other things like that. So in future projections, it doesn't really matter because you're going to set these items to 0 anyway, unless you have advanced knowledge that the company for a fact is going to record something like this. So you really only worry about these in the context of the metrics that you calculate. To determine whether or not you add it back, first off, you have to make sure that it's actually a non-recurring item. I would recommend going back at least 5 years, if not 10 years, and seeing if it really only appears once or twice, and then you could probably call it non-recurring. This has nothing to do with whether it is cash or non-cash. It is simply about whether it appears once or twice or many times. If it appears more than once or twice in a 5 or 10 year period, it's probably not a non-recurring charge. And then the second criterion is that it has to impact the metric that you're adding it back to. So if you're calculating EBIT or EBITDA and the non-recurring charge appears in other income or interest income, it's irrelevant because those items are both below the operating income line. They're not going to impact operating income, so there's no reason why you should add back any non-recurring charges that are buried in these. And that's really it. It's just 2 simple rules for what to do, although there is a lot of subtlety with how you apply them, and judgment and subjectivity are often required. Let's do a quick recap and summary of what we went through here. Non-recurring charges matter because of the historical financial statement analysis and any historical metrics that you use in a valuation. Valuations do tend to be focused on the future, but you will also look at historical numbers and historical metrics as well. And when you do, you have to make sure that you've adjusted for these charges. In this case, for example, for Alcoa, we had this big goodwill impairment. We adjusted for that. And then we also made an adjustment for a portion of the restructuring charge in 1 year. You find non-recurring charges by looking at the income statement and cash flow statement and searching for them there, or you can do a detailed review of the notes to the statements if you have the time and you need to do some more detective work. You add back these charges only if they're actually non-recurring and they're above the line. In other words, they actually affect the metric that you're calculating. So that's it for our tutorial on non-recurring charges. I hope you feel more comfortable with the concept, why they matter, how you find them, and then what to do when you decide to add them back.